In 2022, it's about time we start making some good life decisions, right? Investing is one of the best ways to secure your financial future, and one of the best ways to invest is over time. It may have been tempting in recent years to abandon a long-term strategy in favor of chasing quick returns, but no more. So keep watching to see the best long-term investments in 2022. First up is growth stocks. Growth stocks are the crown jewel of the stock investing world for real. They not only promise rapid growth, but high investment returns too. Growth stocks are usually tech companies, but they don't always have to be. They normally reinvest all of their profits, so dividends are rarely paid out up until their growth slows down. Keep in mind that growth stocks can be risky because investors frequently pay a high price for the stock in relation to the company's earnings. As a result, when a bear market or recession hits, these stocks can lose a lot of value really quickly. It's as if their sudden popularity vanished in an instant, like Thanos snapping his fingers. Regardless of all this, these growth stocks have historically remained among the best performers. So if you're going to buy individual growth stocks, you'll want to thoroughly research the company, which can take a long time because growth stocks are volatile. You'll need to have a high risk tolerance or commit to holding the stocks for at least 3 to 5 years. Because investors are willing to pay a high price for growth stocks, they're among the riskier segments of the market. As a result, when times get tough, these stocks can plummet. However, the world's largest companies have all been high growth companies, so the potential reward is massive if you can find the right company. Next, we have certificates of deposit. A certificate of deposit is an insured savings account with a fixed interest rate for a set period of time. Certificates of deposit are ideal if you know you'll need a specific amount of money at a specific future date. CDs are also an excellent way to safely grow your money over a set period of time. Term lengths of 6 months, 1 year, and 5 years are pretty common, and your investments earn interest. But keep one important thing in mind. If you withdraw funds from a CD before the agreed upon period has expired, you may be charged a penalty fee, depending on the financial institution and their terms. Stock funds. So what do you do if you don't want to spend the time and effort analyzing individual stocks? Your answer is a stock fund, either an ETF or a mutual fund, which can serve as a good alternative if you buy a broadly diversified fund, such as an S&P 500 index fund or a NASDAQ 100 index fund. You'll get a mix of high-growth stocks and others. However, you'll have a more diverse and secure portfolio than if you only owned a few individual stocks. A stock fund is an excellent option for an investor who wants to be more aggressive with stocks, but lacks the time or desire to make investing a full-time hobby. Not just this, by purchasing a stock fund, you'll receive the weighted average return of all the companies in the fund, so the fund will be less volatile than if you had only held a few stocks. If you purchase a fund that is too broadly diversified, such as ones based on a single industry, there's a risk that your fund will be less diversified than one based on a broad index, such as the S&P 500. So if you bought a fund based on the auto market, it might be very sensitive to oil prices. If oil prices rise, it's likely that many of the stocks in the fund will suffer. Investing in a stock fund is less risky and requires less work. However, it can still move quite a bit in any given year, possibly losing as much as 30% or even gaining 30% in some of its more extreme years. For sure, a stock fund is less work to own and manage than individual stocks, but because you own more companies, and not all of them will excel in any given year, your returns should be more consistent. A stock fund will also provide you with a lot of potential upsides. Now for bond funds. The name's bond, and bond funds typically hold multiple bonds from various issuers. They're typically classified based on the type of bond in the fund, the duration of the bond, the riskiness, and many other such factors. One of the benefits of bond funds is that they can be tailored to your specific needs, which many people are looking for in this market. Bonds, particularly those that are part of a fund, are low-risk investments. This is because funds own a variety of bond types from a variety of issuers, resulting in diversified holdings. As a result, if one bond fails, the impact on your portfolio is minimal. Bonds fluctuate, but bond funds tend to be fairly stable. Bond fund returns are typically lower than stock fund returns, but bond funds are less risky than stock funds. Up next is real estate. Another excellent long-term investment to consider is real estate. While it takes a huge amount of money to begin investing in real estate, you'll eventually enjoy massive returns after holding the asset for a long time. So it makes sense that real estate is a popular investment option because it allows you you to borrow money from a bank and pay it back over time. One disadvantage of real estate is the lack of diversification. Having all of your money invested in one asset is extremely risky. However, if you have a good property and manage it well, you can reap some great rewards. And now onto dividend stocks. Dividend stocks are simply those that pay dividends. They're distinct from growth stocks in that they don't generate returns as quickly. Instead, they distribute dividends to investors on a regular basis. Dividend stocks are typically found among well-established companies with little cash need. While dividend stocks are less volatile than growth stocks, they do experience their own significant ups and downs. The primary benefit of dividend stocks is that the companies increase their payouts year after year. So, ideally, you should get a raise every year. Now let's talk value stocks. Many stocks' valuations have been stretched as the market has risen so dramatically in recent years. When it occurs, many investors turn to value stocks to be more defensive while potentially earning attractive returns. These stocks have lower valuation metrics, such as a price-earnings ratio, which measures how much investors pay for every dollar of earnings. Value stocks are contrasted with growth stocks, which tends to grow faster and have higher valuations. So these may be an appealing option in 2022 because they perform well when interest rates rise. Because value stocks have less downside, they tend to fall less when the market falls, and if the market rises, they may as well. Adding to all that, if the market favors them again, their valuations may rise faster than those of other non-value stocks. The appeal of value stocks is that they can provide above-average returns while posing less risk. Many value stocks also pay dividends, so you can get some additional return there as well. Next we have Roth IRA. While this isn't a retirement account, it is one of the best investment options available. Roth IRAs allow you to save after-tax dollars so your investment grows tax-free. You'll also be able to take it out tax-free. Roth IRAs provide special tax and legal benefits and are an excellent choice if you want to grow your investments with no risk of losing the initial investment. And the best part is that if you open your Roth IRA account at a brokerage firm, you'll have the freedom to invest in whatever suits your needs the best. Now for high-yield savings account. Another excellent long-term investment is to open a high-yield savings account. A high-yield savings account pays out more money than a traditional savings account. If you're looking for a place to put your money and earn interest over time, this could be the perfect investment for you. Up next is small cap stocks. Small cap stocks, which are stocks of relatively small companies, have become popular among investors because they have the potential to grow quickly or capitalize on an emerging market over time. In fact, Amazon began as a small cap stock and has made investors who have held the stock extremely wealthy. Small cap stocks are usually high growth stocks, but this isn't always the case. Small cap stocks, like high growth stocks, are riskier. Small businesses are more risky in general because they have fewer financial resources, less access to capital markets, and less market power. But don't lose your heart just yet, as well-run businesses can do very well for investors, especially if they can continue to grow and gain scale. And finally, alternative investments. Alternative investments are a pretty broad term that includes all investments that aren't traditional options, such as stocks and bonds. Commodities, gold, private equity, and cryptocurrencies are all some feasible examples of alternative investments. Because these are generally unregulated instruments, their volatility is high. They're ideal for some seasoned investors looking to diversify beyond traditional investment options. That's a wrap for this video. Which long-term investment plan suits your needs the most? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you in the next one. Thanks for watching.